In the early 2000s, the United States was enjoying what looked like a golden age of prosperity. The stock market had bounced back from the dot-com collapse, unemployment was low, and the American dream of homeownership seemed more achievable than ever. From New York to Nevada, families were buying homes at record rates. Banks were lending freely, investors were confident, and politicians proudly pointed to rising homeownership as proof that the economy was strong and inclusive. But underneath the optimism, a fragile foundation was forming. The entire system from Wall Street to Main Street was being built on risky debt and blind faith in the idea that housing prices could never fall. The roots of the crisis stretch back to the 1980s and 1990s when financial deregulation began reshaping the banking world. Laws like the repeal of the Glass-Steagall Act in 1999 blurred the lines between traditional banks and investment banks. This opened the door for financial giants to take bigger risks with people's deposits. The housing market, long seen as a safe investment, became the center of a growing financial experiment. In the early 2000s, the Federal Reserve cut interest rates sharply after the dot-com bubble burst and the 9/11 attacks hit the economy. Cheap borrowing became the new normal. Money was easy to get, and Americans rushed to take advantage. Homebuyers could suddenly afford bigger houses with smaller down payments. Lenders started competing for customers, offering mortgages that seemed too good to be true. These were called subprime mortgages, loans given to people with poor credit histories or unstable incomes. Traditionally, banks would have avoided lending to such risky borrowers. But this was a new era. As long as housing prices kept rising, everyone believed there was little to lose. Borrowers assumed they could always refinance later. Lenders assumed they could always sell the loans to someone else. And that's exactly what they did. Banks discovered that they could package thousands of mortgages together and sell them to investors as complex financial products known as mortgage-backed securities or MBS. The idea was simple: instead of one risky loan, investors could buy a slice of hundreds of loans, supposedly reducing risk. On paper, it looked brilliant. Rating agencies like Moody's and Standard & Poor's gave these securities top credit ratings, often even when the underlying loans were far from safe. Soon, Wall Street couldn't get enough of them. Investment banks like Lehman Brothers, Bear Stearns, and Merrill Lynch poured billions into mortgage-backed assets. To meet demand, lenders on the ground countrywide, New Century, Washington Mutual started pushing loans to almost anyone who applied. Borrowers were often approved without verifying income or employment, giving rise to what became known as wire loans. It was a self-feeding cycle. More loans meant more securities to sell. More securities meant more profit. Everyone. By the summer of 2008, fear was spreading across Wall Street like wildfire. The financial world was on edge, and confidence, the one thing markets rely on most, was quickly evaporating. Every major bank was being questioned. How much exposure did they have to bad mortgage debt? How many billions were hidden on their balance sheets? No one really knew. In Washington, the Treasury Department and the Federal Reserve were working around the clock. Their offices buzzed with late-night meetings, emergency calls, and confidential briefings. The stakes were higher than anyone could have imagined. The question wasn't just which bank might fail next, it was whether the entire financial system could survive. The next dominoes to wobble were Fannie Mae and Freddie Mac, two government-sponsored enterprises that owned or guaranteed trillions of dollars in mortgages. For decades, they had been pillars of the U.S. housing market. But when home prices collapsed, so did their balance sheets. In early September 2008, the federal government stepped in and took control, placing them under conservatorship. It was the largest nationalization in American history at the time. The intervention was meant to calm the markets, but it had the opposite effect. If even Fannie and Freddie could fail, nothing felt safe. Investors were terrified. Then came Lehman Brothers, one of Wall Street's oldest and most respected investment banks, founded in the 1850s. It had weathered the Civil War, 2 World Wars, and the Great Depression. But in 2008, it was drowning in toxic mortgage assets. As the value of those assets fell, Lehman's losses mounted. Investors and trading partners began pulling their money out. Lehman's executives tried to find a lifeline. They met with potential buyers from Bank of America and Barclays, but no deal could be reached. The government, which had helped save Bear Stearns months earlier, faced a difficult choice: step in again or let the firm collapse. Treasury Secretary Henry Paulson, a former Wall Street executive himself, was under enormous pressure. Critics said bailing out another investment bank would create moral hazard. The idea that rescuing reckless firms would encourage more reckless behavior in the future. On the weekend of September 13 to 14, 2008, after frantic meetings at the Federal Reserve in New York, no buyer emerged. By Monday morning, Lehman Brothers filed for bankruptcy, marking the largest bankruptcy in U.S. history. The news hit like an earthquake. Overnight, $600 billion in assets were thrown into chaos. The financial system went into freefall. Credit markets froze as banks refused to lend even to each other. Money market funds, normally considered ultra-safe, began to break the buck, meaning their value fell below $1 per share. Investors panicked and rushed to pull their money out. The Dow Jones Industrial Average plunged hundreds of points in a single day. It wasn't just a Wall Street problem anymore, it was spreading into. As 2009 began, the United States was in its deepest economic crisis since the Great Depression. The financial system had barely survived the chaos of the previous year, but the real economy was still collapsing. Millions of Americans had lost their homes, their jobs, and their savings. Entire communities that had once thrived on construction and real estate were now lined with foreclosed homes and empty storefronts. The mood across the country was bleak. Factories closed, businesses downsized, and families cut back on spending. Consumer confidence hit rock bottom. The unemployment rate soared past 8% and kept climbing. The auto industry teetered on the edge of bankruptcy, and the banking sector remained fragile despite massive government support. In January 2009, Barack Obama took office as president. He inherited not just a recession but a full-blown economic crisis. In his first major act, he pushed for a large-scale stimulus package to jumpstart growth. The American Recovery and Reinvestment Act, signed in February 2009, totaled about $787 billion. It included tax cuts, infrastructure spending, aid to states, and extended unemployment benefits. The goal was to stop the economic freefall and create jobs. At the same time, the Federal Reserve continued its unprecedented efforts to stabilize the financial system. Under Chairman Ben Bernanke, the Fed launched new programs to pump liquidity into markets. It began buying massive amounts of government bonds and mortgage-backed securities, a policy known as quantitative easing, to lower long-term interest rates and encourage lending. Despite these interventions, recovery was painfully slow. The housing market remained in ruins. Millions of Americans were underwater on their mortgages, owing more than their homes were worth. Foreclosures continued at alarming rates. Banks, still nursing heavy losses, were reluctant to lend. Credit for small businesses dried up. In March 2009, the stock market hit its lowest point of the crisis. The Dow Jones fell below 6,600, wiping out more than half of its value from the 2007 peak. Retirement accounts, college funds, and life savings had been gutted. It felt as if the bottom had fallen out of the American dream. But that same month, something began to shift. Slowly, quietly, signs of stabilization appeared. The government's bank rescue efforts, though unpopular, were starting to work. Through TARP and other programs, the Treasury had injected capital into major banks in exchange for stock ownership. Stress tests were conducted to determine which institutions were strong enough to survive without further help. The results, released in May 2009, brought some relief. Most large banks passed, and investor confidence began to return. The markets responded with optimism. Stock prices started to rise, and the sense of total panic eased. By mid-2009, the economy officially stopped contracting, but the damage was enormous. More than 8 million jobs had been